Hi all, welcome to the CA classroom. Today we will be discussing AS22 Accounting for Taxes. This standard talks about deferred tax liability and deferred tax asset. What is most here is to understand what is the concept of deferred tax liability or deferred tax asset. Now, very first important thing I want you guys to understand, there is a myth. People think when you pass an entry in your books for deferred tax, either liability or asset, you are either paying some money or receiving some money. No. Deferred tax is a concept where it is only a book adjustment for the sake of your presentation. Now let us understand what is this concept with the help of an example. Let us assume there is a company which is purchasing a windmill which cost 100 lakhs. Depreciation as per books of accounts is 20% in straight line method, and income tax they are giving 100% depreciation in year 1. Rate of tax, income tax is 30%. Assume profit before depreciation and tax for 2 years, year 1 and year 2 is 100 lakhs. Let's prepare a small income statement to understand this. First, let us write profit before depreciation and tax. Both the years is 100 lakhs. All the numbers are in lakhs. Less. I will first less depreciation as per books of accounts 20% SLM. Therefore, less 20. Less 20. Year 1 and year 2. Next, I will write profit before tax and depreciation. Now, this is lessing my books of account depreciation. Less. Next will be less my income taxes. And lastly, I will write profit after tax and depreciation. Now, how to compute tax? Let us have a small working note to compute tax as per income tax. For computing tax, we will first, year 1 and year 2, we will take profit as per books of accounts. What is the profit as per books of accounts? After reducing depreciation, it is 80 in both the years. Now, what is the first thing we do in your PGBP chapter? We add back the depreciation as per books of accounts to reduce depreciation as per Income Tax Act. So add back depreciation as per books of accounts what was debited. So I will add back 20, add back 20. I will get a subtotal of 100. Now I will reduce depreciation as per Income Tax Act. As per Income Tax Act, my depreciation is 100%. Therefore, 100% of the windmill, year 1 I will reduce 100. Profit will be your profits as per Income Tax Act, on which I will charge. First year will be 0. Second year, add back depreciations. There is nothing to add back. Only books of accounts will be added back. Depreciation as per IT Act will be 0 in the second year. Hence, profits in year 2 will be 100. Now let me compute my tax. Year 1, profit as per income tax 0 into 30%. 0. So my profit after tax will be 80 in my books of accounts. Year 2, income tax profit is 100. Here my tax will be 100 into 30%, which is 30. Therefore, my profit as per books of accounts will be 50. Now, if you look at this, both the years my profit before depreciation and tax was 100. Depreciation as per SLM, books of accounts, is the same. But only because income tax gives 100% depreciation benefit in year number 1, in my income tax books, when you look at my profit after tax in my proper books, there is 80 in year 1 and 50 in year 2. Decrease in profit in year 2 is on account of higher taxes paid in year 2, because depreciation benefit was fully exhausted in year 1 and there was no depreciation benefit in year 2. Looking at this, what the user will think, year 1 company performed well, year 2 company did not perform well, and he might write off the company. So what we will do is, any issue in taxes and profit which comes because of an income tax benefit, we will try to adjust this for better presentation. Now let us look at this concept. Now continuing the example from the previous section, depreciation as per books would have been 20 in all the years because I am following straight line method of depreciation. However, depreciation as per income tax would have been, first year would have been 100, year 2, year 3, year 4 and year 5 would have been 0. Let us see what is the difference. Now, in normal books, you debited 20 for depreciation. Income tax, you are going to provide for 100 this year. So, my difference is going to be 80. Additionally, I am going to charge 80 as depreciation over and above what is already there in my books in year number 1. However, year number 2, 3, 4 and 5, the difference is only going to be 20 in each of these years. But this 20 belongs to the books depreciation. Now, what is the implication of this? Because of higher depreciation in year 1, you are not paying income tax in year 1. If you remember the previous slide, we had seen year 1 tax amount was 0 because we are charging depreciation of 100 in year 1. But however, does not mean you are saving tax. I am saving tax in year 1 by charging higher depreciation, and in year 2 to 5 by not claiming any depreciation you are going to pay higher tax. That means I am deferring my tax liability from year 1 to the future years. By how much? What is my tax rate? 30%. The difference is 80. So 80 into 30% gives me 24. By claiming additional depreciation of 80, you are saving tax to the extent of 24. Because if your depreciation was 20, your profit would have been 80, and 80 into 30% you would have paid 24 rupees tax. However, in the future years, I cannot claim this depreciation because income tax is 0. So you have to pay 20%, 30% of 20, which comes to 6, 6, 6 and 6. So basically, instead of paying 24 tax, I am deferring it to the future, saving 24 in tax today and paying it in installments of 6 in each of the remaining 4 years. So I am deferring my tax to the future. So what I will do, I will create a liability in my books. Meaning, let us look at now in the next section what happens when I pass an entry for this 24 and 6. So what is happening is, in the previous section we had seen impact of depreciation for all the 5 years. This was the income statement we had. First year profits was 80, second year profit was 80 minus 30, which was 50. How do we correct this difference to ensure that tax does not affect my final part? Now, first year, how much am I saving not paying tax? 24. But however, I have to pay this in the future. Therefore, year 1, I will debit my profit and loss account. That is my P&L. I will debit my P&L account to the extent of profit in terms of tax that I am saving. Year 1, how much I am saving? 24. So from my profit of 80, I will remove 24 and show a profit of only 56. When I debit my P&L account, debit for 24, what to credit? This is going to be a liability in the future. This tax I am going to pay from year 2 to year 5. So I'll credit an account called Deferred Tax Liability 24. Year 2, what happens? You are paid tax of 30, but you have paid additionally how much tax? 6 rupees, because you were not able to claim depreciation benefit to the extent of 20 in your books, which was disallowed. 20 into 30% is 6. So I will add back 6 rupees to my profit. How? Deferred tax liability, which I created for 24, I will debit in year 2 to the extent of 6 and credit my profit and loss account to the extent of 6. So increasing my profit by 6. Both the years, now my profit is on a comparable note. Effect of tax is removed. Now, creating a liability. Am I paying somebody outside? No. Next year I am reversing a liability by again recrediting my profit and loss account. So understand, deferred tax liability or asset. In our example, deferred tax liability is only a book entry for sake of presentation. Now let us look at an example to understand the concept of deferred tax asset. In the previous section, we have understood the concept of a deferred tax liability with the example of a depreciation. Now let us see another example, example number 2. Let me give you the facts. Let's say a company, a startup company which has just started a business, has taken loan of 200 lakhs at 10% interest rate. Interest is to be paid annually, but principal will be repaid only after 5 years. Income tax rate is 30%, and what happened in year 1? The startup company was not able to pay the interest in year 1, but in year 2 they paid year 1 interest along with year 2 interest totally to the bank. Earnings before interest and tax or PBIT is 100 lakhs in year 1 and year 2. 100 lakhs in year 1, 100 lakhs in year 2. Let us look at the income statement in the books of accounts of the company. Year 1, year 2. Particulars. First I'll write profit before interest and tax. 100 lakhs in both the years. All the numbers are in lakhs. Next, I am going to reduce my interest. In books of accounts, what do we follow? We follow accrual basis of accounting. Whether interest is paid or not, we will still debit the profit and loss account. So interest is 200 lakhs into 10%, 20 lakhs in year 1. Year 2 is also 20 lakhs because principal is still not repaid. It will be repaid only after 5 years. Next, earnings before tax or profit before tax will be 80 lakhs for both the years. Now what happens next? I will reduce my tax amount. I will reduce my tax amount. How much is the tax amount? For this, let us do a separate working note. Working note 1, to compute tax in year 1 and year 2. For that, let me take the book profits first. Profits as per books, my starting point. It will be 100 minus 20, 100 minus 20, 80 will be my starting point. Now, in year 1, the company has actually not paid the tax. So what is section 43B saying? Add back those expenses which you have not paid. So add back under 43 subsection B of Income Tax Act 20 lakhs of interest which is actually not paid. So it will be disallowed in year 1. But however in year 2 they have paid, therefore no disallowance. Less again under 43B. What is provision 43B of income tax saying? Deduction will be allowed in the year in which payment is being made. So, year 1's interest, which is disallowed in year 1, is actually paid in year 2. So, you will reduce that 20 in year 2. Profit as per Income Tax Act will be, year 1 will be 100, year 2 will be 60. Therefore, what is the tax? Tax rate was 30%. So year 1 will be 100 into 30% comes to 30. Year 2 will be 60 into 30% comes to 18. Let us take these values here. Less tax 30, less tax for year 2 18. What will be your profit after tax as per books of accounts? What I report in my books of accounts? Year 1 will be 50, year 2 will be 62. Now if you look at the values, profit for year 1 is 50, profit for year 2 is 62. When a user looks at this, what will he think? Year 2 is performing better than year 1. Now, what is the reason for this? Earnings of the company is same. Only because of an income tax provision 43B, where in year 1 interest was disallowed, which increased my profit to 100, and I had paid an additional tax in year 1 compared to my year 2. What happens in year 2? I got a benefit, additional deduction, because you paid tax in year 1, year 2 tax is saved. So what is happening? Year 1 I am paying higher tax and saving some amount of tax in year 2. What is this tax amount? Let us compute year 1 and year 2. Interest as per books of accounts in year 1 is 20, year 2 is also 20. But interest allowed as per Income Tax Act, year 1 is 0, year 2 is 40. How is it 40? Totally in income tax, they are allowing in for 40 as deduction, 20 is already allowed for year 2 and 20 is allowed for year 1 which is paid in year 2. What is the difference amount? 20 is not claimed in income tax in year 1. Additionally, 20 is claimed in year 2. Let us compute the tax impact on this. 20 into 30%. 6 will be year 1, 6 will be in year 2. But however, this 6 is saved in year 1. This 6 is paid. This 6 is additionally paid in year 1, which is not paid in my year 2. Why? Because first year my profit was higher. So you are paying 6 rupees in year 1, which you are saving in year 2. So I am paying additional tax in year 1. Therefore my profit is reduced in year 1. So I will want to increase it back. So what to do? I will credit my profit and loss account with 6 to increase my profit for year 1. What to debit? Deferred tax asset account, debit 6. Year 2, what I will do? I will reverse this entry. Now let us look how this statement will look with deferred tax asset. Now, earlier we had only actual tax paid. Now I will list deferred tax asset. Year 1, what I am doing, I am crediting my P&L because I am paying additional tax in year 1. So, year 1 is 6. Year 2 will be negative 6 because I am going to debit P&L and reverse my DTA. Now, what will be my profit after tax for both the years? Year 1 will be 80 minus 30 plus 6 will come to 56. Year 2 will also be 80 minus 18 minus 6 will come to 56. So presentation wise, because of my deferred tax, both the years profit is same. It is only a book entry adjusting credit of my P&L in year 1 and reversing in year 2. Why am I reversing in year 2? Now, assume this interest is not repaid in year 2, is only repaid in year 3, then I will reverse only in year 3. So what is the concept here is, whatever tax is saved or expensed in 1 year, in which year that benefit is reversing. Now, year 1 I had additionally paid income tax of 6 because you did not pay interest to the bank. In which year this interest is actually paid, that year my income tax will reduce because of additional deduction. In that year only I will reverse this book entry to ensure comparability and presentation. This is the concept of deferred tax liability and deferred tax asset. Now let us see what the standard says and how to solve sums in the exam. In the previous section, we have understood conceptually what is deferred tax liability and deferred tax asset. Now let us see how to solve an exam sum. In exam, they will give you accounting profit 1 lakh, profit as per income tax books 3 lakhs. They will ask you to create deferred tax liability or asset. For the sake of exam, for simplicity, always think income tax books profit is correct and accounting profit is wrong. So I have to move from 1 lakh to 3 lakhs. Only the difference tax impact. So 2 lakhs is the amount of difference, and let us assume tax rate is 30%. So into 30%, you have to create either deferred tax asset or liability for 60,000. Now, which is higher? Income tax is higher, accounts is lower. So I need to increase my accounting profits. Therefore, I will credit my profit and loss account with 60,000 and debit deferred tax asset with 60,000. It will be the opposite. When accounting profits is more than income tax profits, I need to reduce my accounting profits. How do I reduce my accounting profits? By debiting my P&L and creating a deferred tax liability. This is only for the purpose of exam. Now let us see conceptually when a deferred tax asset will be created. Now, this difference in profit is called timing difference. It's called timing difference. Why is it called timing difference? In the two examples we had seen that depreciation windmill was provided fully in year 1 but was slowly reversing until year number 5. Same case for interest. Year 1 it was disallowed, year 2 it was allowed. So all those differences which arise in 1 year and reverse in another year is called a temporary timing difference, and I have to create a deferred tax asset or a deferred tax liability for that. Those cases which are permanent timing differences, for example, dividend income. Dividend income will never be taxable in your income tax books. Therefore, such difference will remain consistent throughout. There is an amendment in the Income Tax Act. So these kind of differences which will never reverse in the future is known as permanent timing differences, and you will not create deferred tax asset or deferred tax liability for a permanent timing difference. Now, deferred tax asset can arise because of unabsorbed depreciation or carried forward business loss or other items. What are the other items? What we just saw, 43B case. The standard tells where deferred tax asset is being created. Now follow carefully guys. Whenever you create deferred tax asset, you're going to increase your profit. Therefore, the client will be happy to create a deferred tax asset and he will be reluctant to create a deferred tax liability because you are reducing his profits. So you need to be very careful when you create a deferred tax asset. The standard tells when you are going to create a deferred tax asset for any other items other than unabsorbed depreciation and carry forward business loss, you have to check if there is a reasonable certainty that this item will be reversed in the future. 43B, it will be reversed in the future. Disallowed in 1 year, allowed in another year. Cases like unabsorbed depreciation and carried forward business loss, standard tells you have to check if there is a virtual certainty if these items will be reversed in the future. What is this? Unabsorbed depreciation is tax saving. Unabsorbed depreciation, when you have unabsorbed depreciation or carry forward business loss, your tax amount will be 0 because profits will be in loss. Loss is equal to tax saving. Now, this year I am saving tax. Will I pay in the future? Will I be able to reverse this in the future? Will this timing difference reverse in the future? Only if you are virtually certain that this will reverse in the future, you have to create a deferred tax asset. So differences can be classified into two: temporary timing difference, permanent timing difference. If your difference is because of a temporary timing difference, create DTA or DTL. If it is because of a permanent timing difference, do not create DTA or DTL. Now let us look at certain other miscellaneous concepts in AS22. In the previous section, we had seen how to solve a sum in exam and few concepts of what is a temporary timing difference and a permanent timing difference. To summarize, in exam, all you have to see is what is the accounting profit and what is the profit as per Income Tax Act. Assume this is correct, assume this is wrong. Move from accounting profit to your income tax profit and pass necessary entries. Now let us look at few miscellaneous concepts. First, what rate of tax should I use? Generally, in most of your questions, rate of tax will be given. But however, you will create in the year of creation of deferred tax and in the year of reversal of deferred tax. Normally, creation, the year in which you create DTL or DTA, is obviously different from the year in which you reverse. Now, you know income tax rates keep changing every year based on the budget. What rate should I take? In the year of creation, take the rate which is in enforce, substantially enforced rate, the rate which is there in the budget. In the year of reversal, take the rate which is applicable in that same year. Let us take a small example to understand how to do effect for this rates. Let's say year 1 was 100, then year 2, year 3, year 4, year 5, 20, 20, 20, 20, and year 6, you are going to reverse 20 in each of these years. Initially, you created deferred tax liability when the rate was 30%. So, year 1 would have been 30, year 2 would have been 6, 6, 6, 6, 6. So, creation of DTL in year 1 for 30, reversal of 6 lakhs in next 5 years. Let us take an example. Now, let's say after 3 years, rate has changed to 20%. Now what has to be done? We have to see, assume it was 20% in the beginning, then it would have been 100 into 20%, 20, 20 into 20%, 4, 4, 4, 4 and 4. This should have been the pattern if it was 20% as the rate. Now, how much is already reversed out of 30? 12 is already reversed. In the new pattern, how much is balance to be reversed? 4, 4 and 4. If you go by the old pattern, I will reverse same amount, 6, 6 and 6. Now, end of year 3, what is the balance in my deferred tax liability account? 30 minus 6 and minus 6 for year 2 and year 3. I will have balance of 18 left. Deferred tax liability will have a balance of 18 at the end of year 3. If it was 20%, then initially I would have created for 20, reversed 4, and the balance should have been 12. Balance should have been 12. So what happens now is, I need to reverse only 4, 4 and 4, but I have balance of 18. I have additional balance of 6. So what I will do, in year 4, I will reverse this 4 plus I will write back my 6 for adjustment and change in tax rate. Year 5 and year 6 I will reverse 4 and 4 respectively. So end of year 6 balance will become 0. So in the year the rate changes, that difference amount will be adjusted in that year. Now let us see few other miscellaneous concepts. Now let us see a few small concepts in deferred tax standard. First is offsetting. Let us say because of various transactions, various timing differences which originate and reverse, you have a few deferred tax asset and a few deferred tax liability. Do not show both in the balance sheet. Net off and show what is the net amount. Next, let us look at another concept called concept of tax holiday. Now, what is tax holiday? Let us take year 1 to year 10. Income Tax Act, through its various provisions for startups, industrial estate, etc., they say no need to pay tax for the next 5 years, next 10 years, etc. In those cases, let us say your company falls and got a benefit of 10 years tax holiday where they need not pay tax for these 10 years. Now, what to do with the timing differences which will lead to creation of deferred tax asset or liability in this time gap? The standard says any timing difference where you have to create a deferred tax asset or liability which originates and reverses within the tax holiday period, ignore the same. Only those timing differences which originate during the tax holiday period and reverse after the tax holiday is completed, for that per part you need to create DTL or DTA. So in summary, those timing differences which need you to create a DTL or DTA which are originating in tax holiday period but reversing after tax holiday period, for that you have to create a DTL or DTA. Those timing differences which originate and reverse within the tax holiday, you will ignore the creation of deferred tax liability or asset. One more concept which I would like to explain is concept of MAT. Now a company might have to pay tax as per MAT or normal income tax provisions. So what to do? Should I create deferred tax provisions based on MAT or income tax? The standard tells MAT is a tax in penal nature. What is MAT? I hope you know it's minimum alternate tax. Let us not get into that discussion. Standard tells always create deferred tax liability or asset only based on tax computed as per Income Tax Act and ignore the tax as per MAT because it is penal in nature. Your computation should depend based on what is the tax in Income Tax Act. So these are some miscellaneous concepts in AS 22. Thank you.